Singapore's benchmark indicator, the Straits Times Index, lost $28 billion just today. And this comes after almost $77 billion was wiped out from the local stock market last week over fears of a recession. Experts think it is going to get worse.
When the first COVID-19 case emerged on 23rd January in Singapore, the STI was at 3,234 points. Since then, it's gone on a downward slide, especially after the World Health Organization declared the virus a pandemic last week, amid a rise in cases worldwide. The index has shed a total of more than 700 points and is now at 2,496 points. The ongoing uncertainty has battered shares, including heavyweight DBS Group, which sank 4% on Monday. National carrier Singapore Airlines also fell by around 6% after it said it will cut flight capacity on selected routes to and from the US. Market watchers say investors are fleeing the market over fears of a recession. This comes after Prime Minister Lee Hsien Loong said last week that the economic impact from the virus is likely to be more serious than the global financial crisis and longer lasting too, even beyond the end of the pandemic. The local stock market rout follows a sell-off in US markets at a state not seen since the 2008 recession.
Right now, what worries investors are the situation in North America and European. So those are world's largest consumer markets. And if things goes wrong in those places, it can heavily impact Asia Pacific as well. For STI, things may get worse before it gets better because local market is very much influenced by what happened in the US and European markets. So it will take the US market to stop bleeding before local market can find a bottom.
In a recessionary climate, experts say Singapore's bourse has a slightly better position as the stocks are not considered overpriced, while its defensive sectors can provide some relief.
We are likely to have a situation where investors would identify defensive counters. Defensive sectors could be the utilities, it could be the liquor stocks, it could be the companies that have paid out high dividends and have very strong balance sheets. There could be a flight towards these names in Singapore.
For now, the experts say that it's still early days to forecast how the markets will turn out for this year, as the gravity of the impact from COVID-19 remains a big question mark.
Stock markets have continued to nosedive in both London and New York. Trading stopped for 15 minutes in New York shortly after the open. Now, a so-called circuit breaker triggered for the third time in the last week following an 8% drop in the S&P 500. Trading has now resumed with the S&P 500 dropping 9%, extending losses. Now all this even as the US Federal Reserve slashes interest rates to almost zero. Britain launches a $39 billion economic stimulus plan just hours after the Bank of England slashed interest rates, but the main European stocks have still been plunging since opening trade. Now let's get more perspective on this from David Kuo, and he is the co-founder of the Smarter Investor. David, good to speak to you. So what's happening on Wall Street and in London right now?
Well, I think people are very confused at the moment. What they're actually seeing is the Federal Reserve cutting interest rates, and they're saying, well, what are you going to do after this? And I think one of the big problems is that this is not, at the moment at least, an economic problem. It's a medical problem. And so really they want medical solutions. What they want is a vaccine. They don't want an interest rate cut. I mean, ultimately, Glenda, cutting interest rates doesn't really have an awful lot to do with consumer confidence. It's not going to get me to say to both you and also Dawn, let's go out and have something to eat because, woohoo, you know, the Federal Reserve has cut interest rates. That is not going to happen. You need to instill confidence in people, and then they will start to go out and start spending money again.
David, you're right. I mean, Fed rate cuts do something for banks, it does something for commerce, but definitely not for the consumer. It certainly doesn't have the tools to do that for the consumer. But let's look at those circuit breakers, what we're seeing with Wall Street. This morning already, after a minute of trade, it was down by about 11%. The circuit breakers hit. The next threshold is 13%. We're looking at the market's down 10.42%. The Dow is down that amount, not far off the second 13% level. Last week it broke twice. What do you make of this?
Well, I think people are very fearful at the moment, and people are saying that I have no confidence in either the administration in America to do something about the problem, just ultimately sort of telling people that, well, I mean, I heard Donald Trump's press conference this morning when he said, oh, look, you know, the stock market went up on Friday. People don't want to hear that. People want to hear what kind of concrete solutions do you have for the medical problem. So ultimately, Dawn, I mean, first of all, you have a medical problem. And the second one is, what are governments doing in terms of fiscal measures? Because ultimately, let's put yourself in the position of somebody who works in a restaurant. And the restaurant owner says to you, you know, business is really bad at the moment. I'm going to put you on unpaid leave, or I'm going to put you on half-time at the moment, so don't bother coming in for the rest of the week. I mean, what kind of recourse do these people have, apart from just going home and hoping that things are going to be better later on? So ultimately, there are three pillars to this. The first one is a medical solution. The second one is a fiscal solution. And then finally, you have the monetary solution. But they seem to have been doing things back to front. They've been taking care of the monetary solution first without actually addressing either the fiscal problem or, in fact, the health problem, the healthcare problem. So people are saying, well, you brought out the big bazooka now. You've actually sort of reduced interest rates to zero. What comes next? And if you haven't got the what comes next, then, of course, people are going to pile out of the market, Dawn.
So I'm going to ask you, what does come next? Because it's zero interest, zero impact. So what can we expect from Asian markets tomorrow then?
Well, I think Asian markets will fall again. But ultimately, what you have to look at is the valuations. At the moment, you are paying less than 10 Singapore dollars for every dollar of profit that Singapore companies make collectively. Now, if you think that Singapore companies are going to recover at some point, then this is really a good buying opportunity. And I've been listening to some of the people that have been commenting on your show, the earlier two people, and I think ultimately it depends on your time horizon, Dawn and Glenda. It depends on how long you are buying shares for. In my case, I'm buying shares for at least another 5 years or 10 years, even though I am pushing 60 at the moment, but I am looking at that kind of time horizon. And whatever problems we have is not going to last for the next 5 or 10 years. So now is a good time to buy. And in 5 years' time, when I come back on your show, Dawn, you'll see what a clever person you are, because you actually bought shares, you know, if not close to the bottom, then pretty near the bottom of the market.
Yeah, there certainly are buying opportunities right now. A quick question for you before we let you go. What else can authorities do here? Because, you know, if traders and investors are not responding to what we're seeing with central banks and even the quantitative easing that the U.S. has now put in place, the $700 billion program, what more can be done?
Well, that's a really good question. I think each country has to do what is right for their country. And I think Singapore is doing the right thing. Hong Kong is certainly doing the right thing by advising people to not quarantine themselves, but to actually sort of keep a safe social distance from the next person. And I think that will actually limit the amount of passing through of this virus to other people. And if you don't pass on the virus to other people, then, of course, you know, we are going to be healthier. And ultimately, I think we just have to ride out this period. And I do stress to people that if you are buying shares, you are buying for the long term. And if you are looking forward to the long term, then keep on buying, keep on trickling money into the market. And I don't think you will go too far wrong in another 5 years' time when you look back.
All right, David, always good to talk to you. Thank you very much for that perspective. David Kuo, the co-founder of The Smart Investor.